liability partnership. And those are generally for licensed professionals. You'll see a lot of law firms form that way. And in general, all the limited partners have some liability protection. The the next level could be any one of a number of different corporate entities. The general corporation entity is generally for the bigger firms. Obviously the huge firms like Apple and Exxon and all those kind of firms would be what they call a C corporation. Um, there's a for smaller businesses there's kind of a double taxation issue that you will want to think about. And what that means is the owners will take income as a regular employee, so they'll pay income taxes as any normal person would. But if they take profits out of the company, they'd be taxed as a dividend. So there's kind of a double tax issue there. While a S corp is a kind of a pass through, so that the owners basically pay income tax on whatever the corporation really makes. So while they take a salary, any of the earnings beyond the salary are considered just income. So there's not that double taxation issue. Um, there's also an S corp benefit. You may be able to reduce some of your payroll taxes. So, for an example, if you're a sole proprietor and let's say you make $200,000, you may be able to file as an S corp and pay yourself a reasonable wage, say 100,000 of that, and you'd only pay payroll taxes on that 100,000, and income taxes you'd pay on the whole thing. So there's a way to potentially reduce some payroll tax liability by filing as an S corporation. Um, the downside of S corporations is that you can only have one level of stock, and you're limited to only 100 shareholders, and you also have to all be U.S. residents. Most of the people on this call, I don't think that that impacts, but if it does, that is one of the downsides. Whereas a regular old C corp, you can have multiple levels of stock. There's no U.S. resident requirement and all those kind of things. A limited liability company is usually what most small businesses choose to do if they're going to elect to be a corporation. It's the simplest way to become a corporation. It gives you some of the corporate liabilities. Um, so it's generally the easiest and cheapest way to go. I'm not saying it's the right way. I would always encourage you to talk to both your tax and your legal people to figure out what the best solution for you is. Regarding taxes on a limited liability corporation, you can have a tax status as either a sole proprietor, or if there's more than one person in the limited liability partnership company, you can have a partnership, or you could file as an S corporation. So there's some flexibility in terms of tax filing for the limited liability corporation. So you can pick and choose between which one you want to file at. And then the final business entity is a nonprofit, and that's for designated nonprofits. Um, you need to get IRS approval, but it allows you to file as a nonprofit and not pay federal income taxes. So hopefully that helps a little bit on business entity types and what some of the options are. So in terms of due dates, everyone's pretty much familiar with April 15th, I think. Hopefully everyone made that deadline this year. So for for individual income tax, the filing is April 15th. For the people who file for the businesses who file as sole proprietors or LLCs who choose to file as sole proprietors, all those schedules C, F, and E are schedules that you would use to file your business income on your individual tax returns. Corporations returns are due April 15th, and then S Corps and partnerships are due on March 15th. And the reason for the March 15th is S Corps and partnerships will provide what's called a K1 to their owners. And those owners then use that K1 to file their individual taxes. So it gives a month leeway to the owners to be able to integrate that into their individual tax returns. If you have people who work for you as independent contractors, you need to provide them a 1099 non-employment compensation form by January 31st of every year. And then any other 1099s need to be filed by February 28th if you file on paper, or March 31 if you file electronically. Most corporations and most individuals can get an automatic extension, generally 6 months after the filing date. So that's a pretty easy thing to do. The caveat there and the warning there is an extension isn't an excuse not to pay what you expect to pay for taxes. So when you file an extension, you need to have a pretty good idea of what your tax payment will be, and will need to pay that. Or if you don't, you may suffer some interest and penalty tax payments when you do file your return. So just keep that in mind if you do file an extension, is that you do really need to do an estimate of what you need to pay, and do indeed pay it by the due date. And then if by chance you don't have a fiscal year end that is the end of December, your taxes are generally due 4 months after your fiscal year end. So most people I think on this call probably have a December year end, so that's not an issue. Moving on to business expenses. I didn't add a slide for income because I figured most people have a good handle on what their business income is and what that means for filing taxes. You sell a widget, that's a sale, that's revenue. Revenue is what you need to claim on your income. Business expenses tend to have a little bit more less defined, I guess I'd say. So diving in a little bit, when you first open your business, the IRS lets you deduct up to $5,000 of startup expenses and $5,000 of organizational costs. And any of the balance beyond that needs to be amortized over 15 years. So most small businesses can deduct all of their startup expenses in the organizational costs. Startup expenses would be things like market research, training, evaluating the business before your business started. And then the organizational costs are typically legal fees, filing fees, things to get your business officially up and running. So again, most businesses, those limits more than cover what you can be able to deduct in your first year of business. Meals and so it's a little gray area here, but in terms of being able to deduct meal expenses, any business travel, and any client meals, you can deduct. There's a 50% cap on that. So it's you need to document pretty well what the purpose of the business travel or the business client meeting was. Um, it's you can't you can't deduct personal kind of things like client social meetings, but if there's a business purpose, you can deduct any meals, particularly as you travel or you meet with clients. You used to be able to provide your employees, on-site meals and that kind of thing. That deduction went away, is going away this year. I point that out as something that changed over the course of the last year. And also entertainment expenses. I believe up until this year, you could deduct 50% of that, but this year that goes down to 0%. So things like taking somebody to the Sea Dogs game is no longer a deductible expense.
So, John, we have a question here. If you
Sure.
paid your startup expenses out of private funds, not company funds, would those still be deductions?
As far as I know, yes. So it's the startup stuff is pre-forming the business. So presumably that's pre having a bank account. So you should be able to transfer those costs from your personal to your business and then take the deduction. Good question.
Another question, what would you consider good documentation for travel expenses?
Um, Obviously, a receipt from whatever the vendor was. I write on the receipt who attended and the purpose of the meal. So
And
nothing extravagant, but just something to document who it was with, what the purpose was, um, just in case you ever get called for it.
along with date and location, presumably.
Along with data, yeah. Presumably on the receipt, it's going to have that. Yeah.
Back to the first question on what is good documentation. Where would you show those deductions on your tax returns?
Are we talking the startup expenses or the meals or?
Startup expenses.
Um, I honestly don't know. Um, my guess is on if I'm thinking about the schedule C on the personal return, you would probably just put them in wherever legal or filing fees would go on that schedule.
Yeah,
I
as I
beyond that, I
recall,
can't
they give
without
you
looking at the form. I honestly can't tell you.
they give you a bunch of specific lines, and if you don't fit
Right,
within those lines, you can always attach another schedule.
right, and they give you the flexibility to add new lines. So yes, the
What
forms are
about
pretty straightforward. Particularly if you're doing a sole proprietor. If you're filing as an S corp, there's a whole bunch of different lines that it could go in a number of places. But without digging into the form, I can't specifically tell you.
and
Hopefully,
I think there was one more. Uh, yeah, Garrett says there are capital startup costs which go on Schedule C for sole proprietors, and there are some lines you can fill in.
right.
So great, that's it for now. Thanks,
Yeah.
John.
Okay. Um, so uniforms, if you have a business that requires special uniforms, I don't know, like if you're a chef, if you're a sole proprietor chef, you can deduct those kind of costs. Businesses also can provide their employees uniforms and can deduct those costs as well. There's some gray area if you're a W-2 employee that you can't deduct uniforms. But in that case, I'm going to guess most of your firms will provide a uniform for you in that case. But for the most part, in general, uniforms that are required for the business are deductible. Business gifts are subject to a $25 limit. These could be, client appreciation awards, those kinds of things. So it's, that honestly, that limit's been around for decades. It hasn't increased over the years. So it's kind of um, absurdly low in my mind, but it is what it is. So there's a cap of $25. Um, you can kind of get around the entertainment not being deductible by, like, if you give a client, I don't know, Sea Dog tickets, you could potentially consider that a business gift, and it could be deductible there. So just kind of a maybe a workaround to give give some entertainment costs to your clients. Again, the $25 cap is, it's not going to get you much, but it is something to consider. Um, Quick discussion on the charitable expenses versus memberships. Um, Charitable, as you probably all know, on your individual income tax, charitable contributions are are generally capped at 50% of whatever the cost is. And on your individual income tax, memberships are not deductible at all. So for your business, um, same thing holds for the charitable contributions, but you can deduct memberships that are valid business organizations. So for instance, if you are in a business association in your industry, the membership to that can be deducted. For the most part, if you join like a chamber of commerce, that membership expense can also be deducted. So it's a little bit different from um, your individual tax situation from your business situation. You can also deduct, this year it's 72 and a half cents per mile for any mileage used for business. Again, you need to track your mileage for business and personal separate and be pretty clear that you've got some documentation. Um, you could,
So
if you travel a lot, you could do a log. If you don't travel a lot, you could just keep an Excel spreadsheet of it, would be fine as well.
Ira asks, I work from home and often travel to a bank or the post office, etc., for business. Will my mileage allowance be to and from home?
To a bank, yeah, should be. Yeah, yeah, you can do that.
Different question. How
There's a
does
little
forming an, go
there's a
ahead.
little grayer area if, for instance, if your business has an office, um, traveling between your home and your office would not be something that's allowed. Commuting miles is not considered um, business, so that would not fall into that category. But if you work from home and you travel to a client or you travel to a bank or a business meeting, those kind of miles should be tracked and can be deducted.
How does forming a Delaware LLC with filing as a foreign business in Maine affect taxes?
How
Do
does
you,
I didn't quite get that. One more time.
their Delaware LLC registered as a foreign business in Maine. So they get loans and banking, presumably in Maine. What taxes do they have to file? Presumably Maine taxes and Delaware taxes?
Yeah, in general, it's general. I can't attest to what you'd have to file in Delaware, um, but in general, you file taxes wherever your income is earned. So if you have a Delaware corporation, but you do all your business in Maine, you're going to predominantly file taxes for Maine. I can't attest whether you've got to file a Delaware return as well. I would say you'd have to check with Delaware. But even if you did do that, most states will allow you to deduct whatever you paid to another state on their own tax return. So if Delaware requires you to file a tax return based upon you being incorporated in Delaware, you most likely would be able to take a credit for whatever you paid to Maine to whatever you owed to Delaware. And in 9 times out of 10, it's a wash. Hope that
And
answered
back
that
to
question.
expenses that can be deducted. Promotional and networking expenses presumably can be deducted as well. But what about mileage incurred on your car to travel for promotional or networking reasons.
It's the same thing. If it's a valid business effort, you should be able to deduct those miles.
Then
Yeah.
software and advertising costs uh, as part of your startup expenses. Uh, Even though you may have incurred them yourself personally before you started your business, those can presumably be transferred to the business as well and deducted as an expense. Do they have to amortize them or can they deduct them entirely in their first year if they're startup related?
Um, as long as they qualify as as a startup cost, and those most likely should, although software, depending on the value, you might need to capitalize and take it as depreciation. I'm not fully sure about that.
If
But
it's software as a service, you probably deduct it annually. But if you purchase the
if that's
software
what it is,
outright,
yes. But if you're
then
buying software, you may need to capitalize that and amortize that, and we'll get into that later. Um, the as long as it's under the 5K limit, you deduct it immediately. If it's anything over 5K, you do have to amortize it over the 15 years.
great. Thank you.
Okay. So you can also, if you choose, you can deduct some of your home office expenses if you're working out of your house. The trade-off there is, I'll be honest, it's one of the red flags that the IRS looks at. So you need to weigh the value of what you're going to get out of that. But clearly things like utility expenses, you could if you beef up your internet, whatever that delta is to run your business, or you can take a percentage of your electricity or your heat based upon square feet or some metric like that. So you can take some business write-offs or expenses for home office expense. It's a whole host of things you can look at. I recommend you do a little research and then think about what your best options are. A little bit about insurance. For an S corp, shareholders' health. Anybody who's a 2% owner of an S corp, that their health insurance can be deducted by the corporation, but it's included as income to the shareholder. So the shareholder would see that income in his or her W-2, and then they can take a personal deduction for the health insurance. It's a little convoluted, but that's how it works. Um, and if you happen to have officer's life or disability insurance on your owners, which is often a good thing to do for some liability protection, those premiums are not deductible. That's just a few. I know you had a whole bunch of questions on other expenses, but that's just a few of the expenses that can be deducted. And again, there's a whole host of others. Any other questions on expenses before we moved on to some of the assets and depreciation? Oh, okay, cool.
Not seeing any others in the comments.
Okay, cool. So assets, what's an asset that should be depreciated? It's generally anything that has a useful life over a year. It has to be owned by the owner, and it has to be used in the business to either run it or to, make things for your clients. Some typical types would be machinery, equipment, tools, computers, vehicles, furniture, and fixtures. The IRS does have a de minimis level of what needs to be capitalized, and I think that currently is $2,500. So some things like computers, you may not even need to anymore consider it an asset and depreciate. You probably because of that 2,500 for the most part, unless you get a really whiz bang laptop, you can for the most part just take it as a current year expense. But bigger stuff, big machines, um, you know, vehicles, furniture and fixtures, needs to be capitalized and then depreciated over its useful life. Safe harbor election for small taxpayers. If you own your building, it allows for an immediate deduction of any improvements or repairs. There's a couple of caveats to that. Your income, your receipts for revenue can't exceed $10 million, and the property value can't exceed $1 million. If those two things happen, you can deduct up to $10,000 or up to 2% of the building's value for any improvements you make to the building. Depreciable life. The IRS has different categories for how long you need to depreciate assets. And we'll talk in a minute that it may or may not even matter for a lot of people. But computers are a 5-year life, furniture, fixture, and machinery is a 7-year life. If you own residential property, it's 27 and a half years. And if you own non-residential property, it's 39 years. Those are some of the big categories that cover most everything. So I just said you might not even need to worry about the depreciable life, and the next two things are what may come into play here. So Section 179 allows you to depreciate in the current year assets that you buy. You can depreciate up to your taxable income any assets that I won't say any, but most assets that you buy for your business. It's capped at 2.5 million, so it's a significant cap. Generally, the issue for small businesses is that you're capped because your taxable income doesn't allow you to do it. So, for instance, if your bottom line taxable income before depreciation is 50,000, and you bought a machine that's worth 100,000, you could only, from the Section 179, only take $50,000 of that. So you can only depreciate in the current year up to your taxable income. However, the bonus depreciation has no income limit or caps. And you can create a loss on your business and carry it forward. So between those two things, most small businesses are able to write off what they buy for assets in the current year that they buy them. The general way to do it is to take the Section 179 first, and then take any bonus depreciation if you don't have the income to cover the 179. But either way, you should take those, and if you generate losses carry forward, it's better to carry the loss forward than to depreciate it over the useful life. Little complicated in how that all works, but just in general, most small businesses can use a combination of those two to write off on their tax return the assets they buy in the current period. We'll say Section 175. If you have rental property, it doesn't include that. So just a little caveat there. Depletion is kind of depreciation for natural resources. So, if you own timberland or a mineral rights or that kind of thing, it's a way to depreciate the value as you deplete that resource. Similar but different than depreciation. I'll stop there. I know there was a lot to digest there. Any questions about that, or did I spin everybody's head enough to confuse you?
Here it says they use a percentage based on the size of their office for their home office deduction. How would this work if you work from home? And when she says how would this work, she means the safe harbor election.
Oh boy. I think it probably doesn't. And again, this is where I'm not a tax professional per se, but my guess is it probably doesn't, because I think in this case, the business has to own the real estate. Um, that would be my interpretation, but I would encourage you to ask your tax person that question. My guess is this is for businesses that own their property. And in that case, your business doesn't own your property.
And she asked, could hypothetically apply to just the office space, but I think you just answered that by saying if the business does not own the office space, then the safe harbor election probably does not apply, but check with your tax accountant.
Right. That would be my read, but I wouldn't give I can't give you a definitive answer.
That's it for questions at the moment.
Okay, cool. Let's move on to a little bit about payroll and a little bit about contractors after that. Um, First thing is, do you have a payroll service or do you self-prepare or self-report? I don't have a good recommendation. It's whatever you're comfortable with. I personally would hire a payroll service just because that's not what you do. Focus your business on what you do, but obviously you pay a little bit for that. So I would do a little research, see what it costs. Um, but it's a headache that I personally wouldn't do, but it's really up to everybody's personal preference. There's a lot of good small payroll providers out there um, that do a really good job. They do all the tax reporting, makes life a lot easier. A little bit about payroll taxes. One thing I didn't put on here is the main paid family medical leave, which is a relatively new program. It's been in the news a lot lately because people can now start tapping into that resource. So if you have a 15 plus employee firm, you need to participate in that. Basically, it's a deduction of 1% of wages paid equally by the employee and the employer. That's capped right now at the FICA wage rate in terms of that 1%. Federal unemployment tax is relatively small. It works out to be a 0.6% on the first $7,000 of income. Main unemployment is based on the first 12%, $12,000 of income. It's really weighted based upon your experience and your industry. I can't give you what that percentage is. It tends to average about 2.5% of the first 12%. And then we're all mostly familiar with the FICA wage base. Wage base in 2026 is 184,500. The FICA rate on that is 6.2% for the employee and 6.2% for the employer. The Medicare wage percent tax is 1.4%. There's no cap on that. So you pay that for whatever you make for payroll. Who can and should be on your payroll? Basically, anybody who's under control of the employer, or an LLC owner who chooses to be an S corp. So it's pretty straightforward. Anybody who works for you basically should be on your payroll. And we'll talk about contractors on the next slide. Tax planning, there really isn't a whole lot. One thing, depending on your size of your payroll, if you do it yourself, you may need to pay taxes more quickly as you grow your business. So it's just for tax planning purposes. If you don't have to pay immediately on issuing payroll, you should plan for saving that money to pay it when you need to. Talk a little bit about contractors. So a subcontractor is basically anybody who controls their work, means, and methods and are not under the control of the employer. Generally, they're independent firms. There are pretty strict rules about who is classified as an employee versus who's a contractor. I put a couple of links here to the IRS guidance and the Maine Development Maine Department of Labor. Um, so you can look at that when you get the slide deck. Those rules are in place because um, both the IRS and the Department of Labor wants to make sure that workers are classified correctly. So if you employ somebody who you control, it basically means you dictate the hours, you pay them on an hourly basis, you provide tools to them. They're generally considered an employee. Um, so so you need to put them on the payroll rather than pay them as a subcontractor. Also, workers' comp, you know, Department of Labor wants to be sure everyone's covered by workers' compensation, and generally they they err on the side of saying that the person's an employee versus a subcontractor. So if you do have a subcontractor who fits the rules, what should you get from them? First off, you should have a contract. You should get a W-9 form, which basically gives you their employee identification number. Should obviously get invoices for them for the work they do, and then you should get proof of insurance from them. So if you do have subcontractors, you need to issue 1099s. Generally, if you pay somebody more than $600 a year, you need to issue a 1099 for them. In addition to subcontractors, other vendors, law firms may need to get a 1099 from you as well. One thing I will point out for those who use Venmo or PayPal, they're starting to get smart on who's using them for business purposes. So just be cognizant of that. You may actually get 1099s. I think right now it's a pretty high benchmark. I saw somewhere it's like $20,000 or 200 transactions for at a federal level, but some states are requiring um, a much lower level. Maine follows the Fed right now, but just something to keep in mind as if you use Venmo or other third party pay people. Any questions on that? The employee versus compensation contractor mostly. Okay, good. Let's look at a couple of retirement things. How can how can you set up a retirement card? How retirement accounts can help save on taxes? Well, you can deduct contributions that you pay on behalf of your employees, first and foremost. If you're a sole proprietor, you can also deduct, your personal contributions you make to retirement accounts as well. Maine did start a mandate. I think actually this year is the first year it's in use. It's called Merit. And if you have a firm with 5 or more employees and you don't have a retirement plan set up, you need to participate in Merit. It's no cost to you other than the withholding and the payment of the withholding. So whatever that tangential cost is the only cost. It's a system where your employees can contribute to, I believe it's a Roth IRA to help them start saving for retirement. So I point that out as kind of one of Maine's mandates. A couple other business retirement accounts. An individual 401k is generally for a sole proprietor or a sole proprietor and his or her spouse. You can do both employee and employer contributions. Has a potential to have a pretty high contribution rate, as we'll see I've got a chart of numbers that limits on all these plans. The next chart, next slide. A SEP IRA is for small firms. It's an employer-only contribution, and it's uniform contributions across your employees. It's kind of like an old pension plan, kind of similar concept, in that everyone everyone is contributed based upon the salary on uniform contribution. Simple IRA is generally somewhat larger firms use it, and they want to encourage their employees to participate by contributing their savings, and it generally has a mandatory match, which is usually 3%. So it's a way to encourage your employees to save and provide a match of 3% or whatever they put in. And then the 401k is the most robust plan, has higher limits and flexible contributions for both the employer and the employee. And it's kind of like the higher end of retirement plans. In terms of contribution limits, the first two are kind of like individual, what you can do, what you can contribute individually. The traditional IRA, I'm just going to look at the 2026 limits. You can contribute up to 7,500, and if you're over 50, you can add another 1,100 catch up. Same with the Roth. For those who don't know the difference, the traditional IRA, you can deduct whatever you contribute on your taxes as a deduction in the current year. The Roth you cannot. You don't deduct. But on the Roth, your contributions grow tax-free and can be withdrawn when you need them tax-free. Whereas the traditional IRA, your contributions grow tax-free, but you are taxed when you pull it out. So the IRS gets you one way or another. It's whether you want to take the deduction now or take it later. And then we talked about the other ones. The SEP IRA has a limit of the lesser of 25% of your compensation or up to $72,000. And then the simple IRA has those limits of $17,000. It has a catch up of $4,000. And then the profit share 401k has a salary deferral of 24.5 and a catch up of 8,000. And if this 25% of self-employment earnings to a combined 72,000, that's the individual 401k that we talked about. So it's a pretty high deduction if you want to set that up as a sole proprietor. Again, there's a lot of mousetraps here. I would recommend connecting with a professional who deals with retirement accounts, because there's no magic answer to which one's right for you. So a review of where you stand and makes a whole lot of sense.
There's one question. Does the main merit program have a monthly service fee?
As far as I know, no. As far as I know, there's no cost to the employer at all.
No cost to the employer. My research shows that it does have a cost to the employee. It's like $22 a year plus a percentage of the balance in the account. But that is a charge to the employee, not the employer.
Yeah, I must admit I looked at it only from the employer side. So that's good information. That would be something that the employee has to decide as to whether it's worth it for him or her to do.
Another question, does the simple IRA or the SEP IRA stop at 72, even though regular IRA stops? I thought even the regular IRA stops in the early 70s somewhere.
Again, I'm going to plead the fifth, because I don't know.
What about
I could do some research and get back to people. Again, as I said, there's a whole host of options here. I would encourage you to contact somebody who deals with this on a regular basis. But I apologize. I just don't know.
Another question in this chart next to the Roth IRA, what does the 50 plus mean for the catch-up contributions?
So if you're 50 years of age or older, you can contribute an additional $1,100 in addition to the $7,500 you could contribute. So it's a incentive for people who may not have saved enough as they get closer to retirement to kick in a little bit more.
Those are the questions.
Okay, cool. A couple of bookkeeping and accounting things. I'm gonna kind of speed up here because I'm seeing we got 10 minutes left. Cash versus accrual. What's the difference? Um, Basically, um, cash accounting, um, you book your income and your expenses when you either receive money or you pay it out. In an accrual, you book your income when you make the sale or when you agree to the expense. So what's the difference? So say in December, you make a sale of $100,000 to sell somebody widgets. And to make that sale, you've got to spend $50,000 from a vendor to buy those widgets. So in the accrual world, you've made both of those deals in December. So you would say you made $50,000 in December. In the cash world, you may pay for those, which the $50,000 to the vendor in December, but you may not collect the cash from your client until January. So the expense would show in December and the income would show in January. Um, so it's just a question of when you pay. Generally, small businesses will use a cash accounting because that kind of tracks what your true cash balance is. There's pluses and there's ins and outs to that, but in general, that's what happens. So for most small businesses, from a tax standpoint, they use the cash reporting. Some small businesses will, for their financial statements, use your accrual reporting as well. So it's just a question of when the cash comes in versus when you book it. Um, so assets versus inventory. So we talked about assets. That's a long-term resource that's used by the business to run the business or to make products. Inventory is, goods intended for resale. It can be raw materials. It can be buying finished products. Um, Part of inventory is a cost of goods calculation. So cost of goods basically is the cost of producing or buying product to sell to your customers. From an inventory standpoint, that you take your beginning inventory, you add your purchases, less your ending inventory. That's the cost of goods for the time frame. Um, and again, it can be a combination of purchases. It can be a combination of of you making something via raw materials, or in the professional service world, it can be a combination of of your mental time. So in the engineering world, basically we would we would track our cost on a job. I mean our effort on a job, and that would be our current basically cost of goods. We called it work in progress inventory. So it's really what you can offset your sales by in terms of the products you either sold or the services you provided. Um, Accounting for rental property, I just point this out that if you have multiple rental properties, you should set up different tracking mechanisms so that you can clearly differentiate your various rental properties. Accounting software and bookkeeping processes, again, this is beyond the scope of this conversation, but there's many accounting softwares that you could use to track your bookkeeping and your tax needs. Um, Always put a plug in to separate your business from your personal. Have a different bank account for your business from your personal. Don't commingle them. It makes it a lot easier to document. It makes it a lot easier if you ever need to provide documentation to the IRS or whoever. And then one final thing on your balance sheet. What is it? What's on it? Basically, your balance sheet contains assets, liabilities, owner's equity. Assets can be current assets. They can be uh, accounts receivable, cash. Longer term assets would be, your machinery, those kind of things. Liabilities, current liabilities would be your accounts payable, your payroll. Longer term liabilities would be mortgages or long term debt. Why does the balance sheet matter? It gives a snapshot of your financial health. Do you have too much debt? Do you have not enough cash? Are you liquid? Are you illiquid? And then if you do an annual comparison, you can see, how you managed different accounts. Was your AR better? Was your inventory control okay? Did you pay your vendors too quickly, too late? Those kinds of things. So it's good to keep an eye on your balance sheet. Quickly, some tax credits. I know I'm running out of time, so I'm just going to highlight this. The next slide, got a couple of resources, but there's a couple of things that you could maybe take advantage of. There's an insurance credit if you have less than 25 full-time equivalent employees and your average wage is less than $65,000. You can potentially deduct some healthcare premiums that you helped your employees with. If you have a firm of less than 100, you can possibly deduct some of the startup costs to start up a pension plan. There's a work opportunity credit. It's probably one way in the beginning of the year. It's a credit for higher targeted for hiring targeted employees like veterans, convicts, SNAP recipients. The credit depends on your group and on the group and the hours worked. Again, that given the world we're in, that probably won't get extended. It did expire at the end of the year. And then R&D credit is a bit broader than it implies. There's if you're in the kind of the hard sciences, if you work to improve products or processes, you might be able to take an R&D credit. I know in the engineering world, surprisingly, it works. It's not an easy thing to do, but it's can be very beneficial. So it's something you might want to consider. And then here's a link for a couple of different resources, and that will be on the slide deck. So that's kind of my little snapshot of things. Don't have a whole lot of time. Hopefully, we answered questions as we went along, but I'll.
There was one more question, I think 2 slides back.
Okay.
Is this how we could possibly cover the quote mental load of notes, unquote, collateral contacts, etc., for therapy as as a tax write-off, since insurance only pays for face-to-face contact?
Could you do that one more time for me?
So I guess they're in the therapy business. They receive payment from insurance companies only for face-to-face contact, but can they write off the additional time that they spend keeping client notes, etc., in some way? My take on that
My
would
my
be
knee
that
jerk
if
reaction is no.
if you are a sole proprietor, then your time isn't really an expense to the
Right.
company. You're just
Exactly.
receiving the profits as income, which you
Yeah.
pay taxes on. However, if you were an employer and you were paying staff to write those notes, then yes, that staff expense would be an expense on your tax return,
Yeah. Yeah. And
and
I mean,
you
that's
just wouldn't get
if you're
compensated for
paying
that
your
time by
employees,
the insurance company.
right. Yeah. Regardless of what the insurance company does, if you're paying your employees a salary, you're paying them a salary and that's deductible. That you couldn't be just because you're not reimbursed with that, there's no ability to double deduct that, if you will. Um,
She goes on to say, you were talking about being an engineer and the mental load of time on the job.
I probably didn't quite explain that correctly. Um, I- so I'm saying professional services are, it's all you're paying for intellectual activity, basically. So in our world, if we had a contract, an engineering design of $100,000, and we estimated we were halfway through it, then that would be what we would recognize for revenue and the expense associated with it. Um, so I may not have spoken as clearly as I should have on that one. Any other any other questions?
She
Um,
says,
so
that's why she was confused. Thank you. So,
okay, sorry about that. There's a slide here about who we are for SCORE. We've been around for a while. And then if you need a mentor, happy to happy to always um, meet with people as all of our other mentors are. So that QR code um, will get you to the proper site to ask for a mentor. All right. Sorry
wonderful.
we didn't have more time for Q&A, but hopefully we addressed it as we went along.
Thank you all for attending. And if you want to work with a SCORE mentor, if you're not already working with one, we invite you to visit score.org or scan this QR code, and we'll be glad to connect you with a mentor to assist you with your questions. Uh, we look forward to seeing you again at another workshop in the near future. And thank you once again for joining us today. Have a wonderful afternoon.
And thanks for all the questions. They were good. Thanks.